Hello everybody and welcome back to another video. We often get asked the question, how do we find the best support resistance areas? Well, there are many tools such as the volume profile and other things that can help us as traders and investors. But simply put, we need to find what we call the defended zones, and we have some of those appearing on the S&P 500 right now. These are areas that when broken mean significant changes are occurring in the markets, and often the move can be incredibly fierce and very fast. We saw a defended zone previously, and of course the ramifications of when that was broken. But before that hits, can we actually turn around? Well, there are some signs saying that we might move towards some gap fills, but there's also a little bit of fear starting to come into this market. So let's break it all down together, look at these defended zones, and of course look at some of the big macro outlooks to bring clarity to an unclear situation. See you soon. Lots to talk about. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos daily. If you like any of those markets, always remember to subscribe and of course give us a thumbs up in today's video if you enjoy the content. Let's begin by talking about the average pullbacks in recessionary periods in the market. Now, it looks and points towards right now we are already in a recession in the US, although we don't have a technical recession right now. Many of you would believe that, and most of the lead indicators are starting to point towards that direction. The metrics sit around 85% chance that we're already in one. And of course, this means that we have to get a very clear situation on where the markets could go from here. In general, during recessions, things go pretty bad. In fact, if you were taking the average of where markets would go, it would point towards around a 3150, 3200 on the S&P 500 right now. Now, how do we get a number like this? Well, as you can see here, deflating the bubble. It's actually been a pretty effective move here for the 2022 bear market. We actually had a paper that we looked at in February, which pointed towards the best way that the Fed could combat inflation, because they can't push the rates up any further than a certain amount without really breaking the backbone of the world, was to deflate asset prices. And this is, of course, by killing demand. Now, we're back at what we call the 20-year average. This is sitting around that kind of 17, 18 PE ratio in the markets. For many investors, they'll look at this and say, oh, well, it looks like it's a pretty good zone to be buying in. Well, it's the average, but it's not a really good price, is it? It's just the average. And of course, we do expect some of these ratios to decline with bad earnings calls. And do remember, and keep this in your diary, next week begins the biggest week of earnings so far. I mean, we're going to have the earnings market kicking off with the big banks. We'll find out their revisions of what they expect to be happening in the future. So where is the market cheap? Well, around this 15 level down here seems to be a very good zone in the future, and that's been very, very consistent. And of course, if you can get GFC style lows like a 12 or an 11, you feel pretty good. So how do we get some of these numbers? Well, we look at the average recession drops and returns over time. So if we look at the average recession, the average one comes out at 32%. That pushes us down to around, on this SPY, that pushes us down to around a 3200 level. So around 3150, 3200 would be a average kind of case recession period. And why this is important is so that you expect these things and that you're not, let's say, confused or don't have a plan when things come down. Remember, you must have a plan and practice patience if you're an investor. If you're somebody that just says, look, I'm going to buy the dip, and you're in a situation such as we are right now, what if it goes down another 10%? Can you handle that? These are the questions that most investors ask themselves daily. And of course, at this stage, if we are already in a recession, which I think most of the stats are pointing towards like an 85% likelihood, I personally think we are, but we'll find out, then 32% seems like the normal kind of pullback. Now, that doesn't mean that we're in a recession as in it's all going to crash right now, tomorrow. We don't know that just yet. Sentiment is a very important component of trying to understand how markets move. And at the moment, people are very bearish. Most retail traders out there have a very good idea that they believe that the economy is going down. So 52.8% last week, as of the 6th of July, were saying that they were bearish for the next 6 months. Now, generally when everyone has a certain opinion, the markets tend not to be able to go in that direction. And at the moment, 52.8% of people are bearish. I'd like to see that turn a lot more bullish before potentially the market turns around. We'll understand that when we look at the charts a little later in today's video. Some other things that are worthwhile pointing out: the first half of July, which so far has been okay. Obviously, the Monday session was red and the futures as of this time of recording are red, but they tend to be the strongest period of the year. Will we get it again coming up into this Friday? There's actually 3 big bits of news that are coming out. Can the market actually force a rally through those big bits of news? People are very fearful. Will we get a turnaround Tuesday? We'll talk about that soon. July 2022, here's a bit of a cheat sheet for what is expected throughout history. As you can see, the week that we're in at the moment tends to be kind of randomly bullish. Tuesday, Wednesday, Thursday, then the Friday, the big options expiration before the earnings season. That tends to be that kind of bearish section, and then things become very unclear data-wise. Some of the worst months of the year are August, September for the US, and that certainly could be happening again here in 2022. Remember, we've got to expect a double dip at this stage. Another thing that's important to note is that it's not just retail traders that are really short. Pretty much all of the big players are incredibly short. Now, I don't mean just a little bit. They are now at a record short since really the GFC. This is some of the biggest selling that we've ever seen on the markets, and this is coming from the big players. So it's not just retail that's now short, it's the bigger players. And usually what happens there is they add to their position as markets go up. A lot of people don't really think about the way that shorts are added. Now, at this stage, there's tons of shorts in this market. It becomes a bit more confusing when you have so many. When everybody believes it's going short, not always does the market go that way, but we do need to be aware this is how it is underneath the hood. And if you're uncomfortable in a situation like this, you've got to practice risk management. Be fast and nimble, because the VIX, or the fear index, is above 25, and often people will use options around this period of time with, of course, the correct risk management and ability to understand, they're paying a lot more for the options because, of course, they can fix their risk. And this is really important because we have most of the street really short. We've got retail thinking the market's short, yet the market still some of the smart traders may be able to push this market up first. You'd be surprised how these bull traps can appear. Let's talk about the current markets right now. Of course, we have the main 4 here. Now, it was a pretty poor session overall. We did see that rally coming off through the middle of the day. For anyone that was watching our streams, we talked about the second support or demand zone. It ended up holding up for the S&P 500 and it kind of rallied around and then moved up to a very important level we're going to talk about later on today's video. And boy, oh boy, do I think it's important. We'll discuss it very, very soon. Huge shorts coming off a very big zone. Then what we end up going with was the short into the end of the day, which has continued into the futures market. And that's important that that has happened. What about the sectors? Well, it was all defensive. Utilities, staples, healthcare. These were the sectors that were doing well. They are what we call defensive sectors, and all of the recent pickups, that has been biotech, semiconductors, consumer discretionary, solar, and clean energy, these really risky kind of stocks or growth stocks, they were the ones that were down. It again lies into the actual idea that the market was bunkering down through the session. We'd like this to reverse on the Tuesday for us to have any chance that this market can continue to go up, but we will take a look at the charts soon. So speaking of being nimble and fast in the current markets, one of the most important things for scalpers and day traders is, of course, their brokerage costs. And I'd like to thank the sponsor of today's video, Tiger Brokers, because they're coming at us with a promotion, 90 days of free brokerage with any amount of deposit funds as little as 1 cent. This is a bit of a quick breakdown for the difference in brokerage costs between Tiger Brokers and some of the other big providers here in Australia. So just a quick last chance offer for everyone that's Australian. If you're interested in opening an account with Tiger Brokers and getting the free Apple stock promotion, this is your last chance to do so. As of the 12th of July, 6 p.m. Australian Eastern Standard Time, the promotion is over and you will need to open an account and fund it before then. But one great thing about Tiger Brokers is they open your account fast. So if you want to get it, get in right now, and you can get some of the features such as, of course, the sector rotation maps, which I love so much, and the big thing coming up and moving forward, which we'll be using on the channel, which is going to be the earnings calendar. Now, for any Australian out there as well, you're going to like the div one because, of course, in Australia, dividends are totally different to the rest of the world, and any Australian viewer will know that. So get in now if you're interested. and don't miss out, guys. So let's jump into these charts and talk about copper. And first up, Dr. Copper's not messing around right now. Demand destruction in full force. As we know, if copper is going down, it's kind of pointing towards the Federal Reserve really bashing the economy around, and this is the central bank policy around the world. The faster and the harder they raise rates, the more copper is going to go down at this stage. It really is starting to hit the economy in a bad way, and the metals market is seeing this. Same with oil, same with a few other things. Now, what is that causing? Well, because rates are going up, it's becoming more desirable to own cash, and the US dollar is the #1 cash to own in the markets right now. Of course, with all the problems going on in Japan, and on top of that, the Eurozone, it's really just become a one-horse race. Gold isn't doing so well anymore. It's just about the US dollar. Everyone wants the major, and it's sitting at 108.26 right now. Now, eventually this will turn. There's no doubt that eventually the US dollar will turn back down, just like most currencies. But we hit a very important area just in the last session. We've ramped so hard here over the last couple of months. We obviously remember that double bottom, man. I remember that well. That was a great trade for anyone that's been holding little scaled out positions this whole time. But we've hit a critical point. We've hit previous support, previous resistance, and a supply zone. Somewhere around here, maybe we take a break on the US dollar. But of course, a rising US dollar is not boding well for the S&P 500 and in general, any risk on assets at this stage. It shows a hunkering down of people in the risk assets. Speaking of rising US dollar, what else do we have? Well, unfortunately, the 2-year rate continues to go up as well. And this is pointing towards, the potential of this whole market recovery. This is the S&P 500 being false. As we know, if rates are going up, and I tweeted about this, and the markets are going up, that has not boded well in the past. Rates going up, market going up, and obviously we know what happens. And this has happened now 3 or 4 times in 2022 so far. So we've got to be very careful of that. Some other things that are interesting here, take a look at gold, speaking of it. Now, here's a defended zone. We've spoken about this in the past. You can see the ramifications of when a zone is broken, an incredible short that just goes straight through that level. This is because it liquidates all the orders sitting behind this zone and basically pressures all the way down. Now, is gold at a level of demand? It has just reached one, and this is going to be a pivotal point here for gold. And I'll just zoom in here so you can see it. Firstly, there is a secondary level, obviously in the 1680s, that's going to be important to look at. But take a look at this current price action as of the time of recording. This looks like distribution, of course. Market comes down, market weakens, and at the moment looks short. And there's no doubt that is the current trend. But imagine this if it then breaches through this level. At that point, there's a good chance that it will come back down and then actually go long. So this will be an interesting one to watch. I think patience is the best kind of course of action here on gold if you're trying to go long. There are no signs right now to say, oh, this is looking really, really bullish on the higher time frames. You're going to want to see money flow, which we will be covering on the channel, and a whole bunch of other things. It's hit the first demand zone, it's found some buyers, but at this stage, still firmly intact with the shorts, and there could be a really good chance here that it goes to 1680. But it's funny how it's kind of just hit this level as the US dollar hits that incredibly important resistance zone. Let's take a look at oil. So oil changed trend in some ways, smaller time frame, changed trend here, and then it changed trend backwards. So it's pretty confusing here in oil. If you're going to go with the current trend on something like a 1 hour, it would be short, and the market would be looking towards further shorting potential. Now, I've not been a fan of oil for a while. I've thought that the demand destruction was well in place a little while ago. And if we take a look at the daily, you'll see what I mean. There, that big candle here. When this happened, I thought it was all over for oil, and I continued to believe that at this stage. I still think it will get underneath this zone. Obviously, that's against what a lot of people believe, but I think that while the Fed continues to raise rates, we're going to actually see a destruction in the long-term yields, inversion, demand destruction, all sorts of things. And don't get me wrong, oil coming down is not a good thing at the moment. It might sound like it's good, but it's okay if it stabilizes. If it starts to tank hard, yeah, we're in a recession for sure, and it's really, really bad kind of sign. So at this stage, we've got really heavy support here, obviously a 200 daily SMA sitting around that point. We could see the market fall back down and start testing this level, and I think some oil day traders are going to be looking towards that level. Be careful out there, guys. Geopolitical situation, very risky is the oil trade. Let's move over to Tesla now and talk about stocks. Tesla sold off this kind of resistance. We've been looking for Tesla to break here to show us it's really committed towards filling that gap zone. Nothing much has changed here. If the Nasdaq is doing well, Tesla will outperform. If the Nasdaq is doing poorly, the Tesla trade will underperform. And of course, it will go much more against it. You'll notice the volume profile that we have here on the chart in terms of visible history is sitting around a level that has been kind of an important zone in the past. I think a lot is really coming down to Tuesday. Tuesday is going to be an important turnaround story on the markets. Can it be turnaround Tuesday? That's actually a statistic, by the way. What happens on Monday often is changed on Tuesday. Turnaround Tuesday, I'll bring the stats too. I'll get someone in the community to get it together because it's super interesting stat. It does hold up. Let's have a look at the DAX. This is the weekly. So we ended up getting a bullish hammer weekly with no follow through. And I think that's the important thing. Let's scroll down to a 4-hour chart. Have a look at the DAX futures here. Some of you will notice, let's see if you can pause it. What kind of pattern do you think it could be forming here? I'll give you 1, 2, all right, 3. Let's talk about it. So we've got inverse head and shoulders, left shoulder, head, right shoulder, and obviously there's the neckline. So if it does breach through, what are we looking for? This point here. And I think at that point, if that does occur on the DAX, we'll be going towards that real bull trap level on the S&P 500. And we'll talk about that soon. That 39, kind of 84,000 zone would be getting reached. This is all still actually holding okay. It's kind of at a level of small support on the small time frames, but the DAX is not really controlling this market. Of course, it's all about the US markets. Let's look at a couple of ratios. The first ratio I want to look at is SPY and QQQ. So if we look here, the tech sector has been doing much better in relative performance than the S&P 500 recently. One pullback day. So in the previous session, it was all about defensive sectors. That's why the Nasdaq did not do well. Turnaround needs to happen pretty much on the Tuesday here. XLY, XLP, risk on, risk off in markets. A series of, unfortunately, lower highs being formed here. Need to see a new higher high to show us that risk is really on. And of course, a new low here. Really, that at that point, I would say that this market is probably cooked and we're going down to the 3,500 zone on the S&P 500. And we'll look at that soon. Let's check out Nasdaq here on the charts. We hit the resistance on the Friday session. It was too much for it and it fell off. Let's have a look at the little gap that's been left behind. So there's now a gap here. Turnaround Tuesday certainly could fill it. Notice the market for the day actually held the low. Now it's underneath the low at the time of recording with the futures market, but that doesn't mean that it won't come back up or it doesn't have this potential to still fill. So the trend still here on most of the time frames, such as the 2-hour here on the Nasdaq, is actually still bullish. But where you know it's all over and bad things are going to happen, of course, down here at the defended zone. I prefer using the S&P 500 right now, so let's take a look at that. First up, if you're a bear and you're shorting, of course, shorting into these levels could be very, very valid to you. If it gets through this level, this is what we call a defended zone. And what the defended zone tends to be is it tends to be a bunch of wicks on certain time frames, which holds orders. And usually when you see 1 or 2 or 3 of them in a row, it's kind of that area where the market's pulled back to and it's found, a lot of buyers. There's usually a lot of buy orders here and the stops are sitting behind it. So why it's so important is because it's been bought so many times. It's been bought in this structural formation here. And then as it's dumped off aggressively in the previous history over here, it's found buyers, it's found buyers, and it's found buyers. It generally shows you accumulation on a position like this. When these levels, such as when it happened with gold, get broken, or over here, where we have a monstrous level of support, usually a lot of wicks on the smaller time frames, holding kind of structure, the market, once it gets through that level, just goes ballistic. Algorithms get in full control, especially when it's to the bear side. So 3740 is such an important level to have on our charts and alerts for in the future. I'm not sure if a market can hold above this level. Like if it gets underneath here, it's all bad. 3,500 coming in, at least the way I see it on the charts right now. Let's talk about the next 24 hours though. Will we get the turnaround Tuesday? We'll notice the little bit of buying in the end of the day here on the SPY. It pulled up after making a new low. Now at the time of recording, we are a little bit lower in the markets. Markets have sold off a little bit more. We're probably sitting around in here, but it's very, very possible that we actually rally through here And this is the important zone, 3880. And I want to show you this using the futures market. So let's go over here and look at the smaller time frames. Notice the defended zone now on the peak. And why this is so important is look at the history of how this has worked. So we have support, 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 doji, resistance, resistance being supply now, supply. And each time when it did rally off that level, notice the wicks. Then the wicks came up and just bang, straight down with the short. If you're feeling really bullish, you've got to be careful of this zone. So if markets do end up going through, I think 3860 is going to be super important for the next session. Upon 3860 breakout, I'd probably expect it to go towards the 3880. And this time, if it gets up here, there's a good chance it breaks through. But if it does, super significant. Then we move on to the gap fill, which is going to take us up into these levels. And I tell you what, this is a big level here. 3880 has proven itself now as a super resistance zone. To bring it back into perspective, let's go back in some history here. There was another similar period over on this left-hand side where we had similar zones. Some of those zones were like around this level, but notice again here, we have kind of like a shorting, a shorting, a shorting, higher low, then we breach. And once we get through these kinds of sell-off levels, these supplies, we tend to really push the action. You can see the aggressive market action after it. If you can highlight these areas, you really do quite well in day trading. And of course, you've got to be patient, react, and don't predict if you can in these situations. Let's move over to the options for the week and have a look at where they're sitting. So for the 13th of July expiration, we're sitting at 386, which is currently above the current price. So that's going to be an interesting one to see whether we do get back to that. And remember this Friday, as it sits right now, 392. Now, if you go back and then come forward, you'll notice that a lot of orders seem to be sitting. There's a decent amount of puts sitting around 380. So is that our floor for this week? Is 380 our floor or is 370 our floor? These levels have a lot of puts on them. Now, we call them put walls. Basically, if we see interaction with these levels and we see strong price action movement, it can be a tick towards you saying, okay, smiley face, I know what you're doing. You're defending that zone and moving up. Options should be used in conjunction with your TA. Never use max pain as the only reason. Just because you think, oh, the market should go up. Yeah, if the market's showing you the signs, it's good for confidence, but it is not a reason upon itself. Bitcoin, of course, struggled due to the rest of the markets. People say Bitcoin is leading the market at the moment. I'm not so sure about that, but a lot of people are starting to convince themselves. Notice this huge volume. That was random, how much volume went through at that stage. But yeah, look, it's weakened here. It's back at a little bit of a level through the middle zone. You can kind of see that previous demand. If it's going to buy, it's going to have to buy here. And again, I think the stock market's going to predict its way up. If you haven't already, come and follow us over at FX Evolution. And of course, follow us in Discord. We've got a public Discord of 10,000 members. We've also got a private Discord where we stream the pre-open for the markets Tuesday, Wednesday, Thursday, and a whole bunch of other streams that we do for you guys. And remember the news for the week ahead. This is all about the big bits of news. We've got core CPI on Wednesday before the market opens, 8:30 a.m. That's going to be a big one. Remember what happened last time with core CPI? The market went down. That was a big thing. PPI, July 14th. And of course, retail sales. And we're seeing that 8:30 a.m. Now, if I was having a guess, I would probably say that the inflation is slowly coming down. I think the forecasts are kind of, mixture of that, getting close. Maybe we get another peak. From what I've seen by the market's kind of predicting inflation is slowing down. That doesn't mean it is not elevated, and that's important to note. Do remember, anybody from Australia out there, it's your last chance to get that free Apple stock and other stocks as part of the Tiger Brokers special. So don't miss out. If you're interested in getting that, click on the links in the description, pinned message down below, and you can do that and fund your account before the 6 p.m. 12th of July deadline. If you haven't already subscribed, smash that like button, subscribe, and we'll see you in the next one. Bye for now.